Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hello, everyone. I'm Zach from Earmark, and thanks for joining us today, live or watching this on demand. Welcome to What to Do If Your Client Didn't Take Reasonable Compensation Last Year. I'm going to hand this off to your instructor for today, John Morse. John, please take it away.
Thank you very much. Let me just begin by expressing to you how much I really appreciate your willingness to get things right. I suspect that you're taking this class because you've had some experiences with reasonable comp that either didn't or aren't going right. And I very much appreciate that you're trying to fix that. So let me start literally by tipping my cap to you. And now let me turn off the camera so that I can, for the rest of this hour, distract you in ways that don't involve a camera. So I'm the oldest of 10 children, and many of my brothers and sisters and nieces and nephews are in business for themselves. And many of them rely on me for counsel on tax and financial issues. Some come to me later in the process when things have already gone awry and need to be fixed. Today, I intend to share with you the details of that counsel as it relates to paying reasonable compensation after discovering it wasn't done or wasn't done right in the first place. So for the next hour, I'm inviting you to be family. And I know you know that sometimes family can be passionate and authoritarian while being absolutely committed to your success. So please accept my passion and occasional sarcasm and authoritarianism, knowing that I'm committed to detailing how bad this fix can get so that going forward, you'll know to focus on keeping your clients out of the situation to begin with, while at the same time knowing how to extricate clients that find themselves in it. I've got a very small CPA firm in Denver. It's now me and one of my nieces who helps me with bookkeeping, administration, and campaign compliance work that we do a lot of every other year. We've been bigger, but we're working on to get better and at both what we do and how we do it. Because really, I don't care at all about top line revenue, but I care deeply about the bottom line because someday that will hopefully be the source of my retirement. I opened this practice 11 years ago after leaving the Colorado State Senate, where I most recently served as the Senate president. Prior to that, I served as a police chief, rising through the police ranks in the Colorado Springs metropolitan area. Long before that, I was a CPA right out of college for Fox & Company and eventually an audit manager at Deloitte Haskins & Sells. And that gives you a sense of how long that was, since it's not even called that anymore and hasn't been for a long time. I have a PhD in public policy, a master's in tax, a master's in public administration, a master's in business administration, and I'm a licensed CPA in Colorado. So I've studied the law, written the law, enforced the law, and perhaps most importantly, complied with the law for decades. So again, I appreciate you taking this class to learn how to comply with the IRS's requirements that corporate owners of S corporations that provide services to that corporation are employees and must be paid reasonable compensation before they can take any distributions. So very quickly, what we're going to cover today in the next 60 minutes or 55 or so now, and so I will go at lightning speed, truthfully, is as follows. I mean, first we'll talk very briefly about reasonable comp and what it is. but I will recommend to you several times during this course, Paul Hammond from RC Reports, who sponsors this webinar, puts on another webinar himself. That's reasonable compensation for S Corps. It's a 2-hour course, and it's really important. And he goes into all the wherefores and why-tos of what it is, how you do it, some of the pitfalls and whatnot. Whereas the course you're taking today, right now, really directly relates to, okay, we've screwed this up, how do we unscrew it? So today's course is very practical and almost bookkeeping-ish, whereas Paul's course gives you a much broader lay of the land with respect to reasonable comp, which I really believe firmly you should have. So make a point to make a note of that and take that other course so that you know what reasonable compensation really is. So the second thing we'll cover real quick is, when a client comes to you and wants to make an S election, to think logistically, is this really the right time of the year to be making that election? But the crux to this course is you discover reasonable comp hasn't been paid first in the current year. So like right now, it's December 19th if you're watching this live. So it's right at the end of the year. And if you were to discover one of your clients made an S election without you and didn't do any compensation, what do we do? And under a couple different scenarios. One, we've got the cash available, which is the best case scenario. Not very realistic, truthfully, but the best case scenario. And the second way is when there is no cash available, and there's a standard approach to doing that and an aggressive approach, all of which we'll go over. And then what if you discover this not today, but a month from now, in January of the subsequent year? What do you do if you've got cash available? What do you do if you don't have cash available? Because your options are limited compared to what they would have been in December. And then the same, you figure this out in February or later in a subsequent year, or you take on a new client, figure out they made an S election 5 years ago and they've never paid the owner, shareholder, employee a dime. And so you've got 3 years worth of exposure. What do you do and how do you do it? We'll talk about penalties because they're steep on the payroll side. And then we'll talk about what to do going forward to match payroll with distributions so that your client can get both, assuming they want both, and there's money to do both. And then I'll share with you some parting thoughts if I've got time. But again, I will kind of have to race through this, so we'll see how this goes. So very quickly, reasonable comp, the definition. The regulations say that reasonable compensation is the value that would ordinarily be paid for like services by like enterprises under like circumstances. Great, that's very helpful, IRS. Thank you very much. Since there's really no such thing as like circumstances and like services. Every one of us is different, just like our fingerprints, and so that's not very helpful. But then two, in the code section 162, which talks about ordinary and necessary expenses are deductible for businesses, it actually specifically addresses reasonable services rendered. And again, Paul, in his course on reasonable comp for S Corps, will talk to you about, we can use replacement cost to try to figure it out. We can use fair market value to try to figure it out. We're not going to worry about that in this course at all. We're just going to assume we have the number. Where did we get the number? Frankly, my answer to you is you subscribe to RC Reports and get it there, because they do an outstanding job of figuring this out, have all kinds of databases to help them do so. And when the IRS shows up, you're basically going to be bulletproof, and that's what you want to be. So client comes to you now, the end of December, middle of December, and wants to make an S election. Should we do it? Should we not do it? Well, first thing that we consider is, where are we in the year? If we're January, February into the 15th of March, we can file the form, make the election lickety split, no problem, go back to January 1 and do payroll, as of 2.5 months ago, or we can make the election even today to go into effect the 1st of January. But if we really are the 19th of December and, hey, I want to make an S election retroactive back to January 1, 2024, you can do it. You can file a late election form. I will tell you, I've never had one denied by the IRS, so chances are it will be accepted. But we got to figure out how to go back and pay them for the whole year, which you're going to see here in a minute, and can be a real problem. Plus, lots of people don't think, every time I have a new client, a potential new client on the phone, I don't talk to very many of them because I don't take them for the most part. When I say something about, well, I got an S corp and so I need a new CPA. What are you doing with reasonable comp? I mean, what are you talking about? What do you mean reasonable comp? So we've got to figure out in step 3 here, how are we going to figure out reasonable comp? And the answer is RC reports, frankly. But then do we have the cash to go back and pay payroll for this whole year because somebody wants to make the election now at the end of the year? It's a good chance the answer is no. And so if the answer is no, it's like, you know what, let's not do this now. Let's get our ducks in a row and we can start this January 1, 2025 very quickly and easily. Whereas when we're trying to start it in 24, at the end of 24, it's nowhere near as quick and as easy. And then finally, do we have a payroll system ready to go? Lots of these S corporations that you and I deal with are single member, single employee LLCs that have made an S election. So they are the only employee. And if they're not yet an employee because they haven't yet made the S election, or they have and didn't know they needed to become an employee, and that's part of making an S election, there's no payroll system set up. So we got to set one up. That's going to take us some time. I mean, even if we call ADP, they're probably going to need the better part of a week to get this thing up and running. And if we're going to do it ourselves through QuickBooks or something, we got to set up all kinds of accounts. I mean, even the EFTPS account takes 48 hours to set up before you can make a payment. So there is some logistics to deal with. If you've got other employees already and you're just going to add the owner now as an employee, then we do already have a payroll system up and ready to go. But those are the kinds of questions that we want to address to decide, should we make an S election right now or should we wait till the 1st of next year to make that election? So now to the reasonable comp itself and the gymnastics that we always have to jump through. So the first thing we have to do is determine the reasonable compensation amount. And as I've said, we're assuming it in this case to be $80,000. I mean, go to RC reports and it'll spit out a number for you and bam, you've got it. One of the things that I see done wrong so much of the time is health insurance for S corps. So remember that if the S corp owner is providing health insurance for himself or herself and their family, it needs to be run through the S corp. So we don't want to pay that privately. And if we do pay it privately, we got to get it onto our books, making a due to, due from kind of thing where we reimburse the owner for the health insurance that they've paid, but it's quicker and easier and slicker to just pay it out of the S corp all the time so that we can add it to the W-2. Because we have to add it to box 1 wages in order for the shareholder to deduct it on their personal return. So health insurance actually gets deducted on their personal return, not on the corporate return. So the debits and credits of that, if you think about it, when the S corporation pays the health insurance costs, we generally debit health insurance expense and credit cash. And that's what we do in my firm too, I will be the first to admit. Then towards the end of the year, hopefully in October, so that we aren't cramming ourselves too much, we actually do a reclassification and change that health insurance expense. We credit health insurance expense and debit officer's salary for that $10,000 so that box 1 wages, which I'll show you here in a minute, turns out to be $90,000. And we're still only paying them 80. We're paying 10 on their behalf. But if it doesn't show up in the W-2 as box 1 wages, and then again as box 14 S corp medical premium, we don't get the deduction. And even in this case, I'm assuming $10,000 a year in cost. Chances are it's going to be more than that, but $10,000 is easy to work with, so that's why I've chosen it. $10,000, I mean, that's going to save them $3,000 in tax. It's real money. We want to do this right. If we don't do it right, then we don't get the deduction. So if the IRS comes in and audits you and you've just left health insurance for the shareholder owner employee in health insurance expense, you don't get to deduct it. You do get to deduct that for all the other employees that aren't 2% or more shareholders, but you don't for the officer. So you just cost them $3,000 in tax benefit in round numbers. So we want to make sure that we do that. And that's why I'm harping on this, because I see that done wrong so much of the time. So once we've figured that out, and assuming that we made the S election today and we're going to pay them, we've got the cash to pay them, what do we do now? Process payroll. That 80 grand, make sure that the $10,000 gets accounted for health insurance and shows up in box 1, does not show up in box 3 or 5, meaning that that $10,000 health insurance amount is not subject to Medicare or Social Security tax, but it still has to be in box 1. So we figure that out, process payroll, and then pay the payroll taxes. Don't forget that companies got to pay their share of Social Security and Medicare, and maybe we do some withholding as well for federal and state taxes. No big deal. We do that throughout the year. All this makes perfect sense. But if your client has made the S election and has not done any of this, this is what this course is about, where we got to get this caught up. So this is a slide that you might come back to when you're actually doing this in January, to figure out that you've really done things right and you reconcile box 1 wages and box 5 generally. Because in this case, and I'm showing you, assuming they've got a 401k plan as well, which again, I know that's not a perfect assumption, but I just want to show you so that you can really see how this works, where we've got $80,000 in reasonable comp. We got to add $10,000 to get us to 90 to box 1, and then we subtract the $23,000 max for 2024 401k contribution, so that box 1 really turns out to be $67,000, and you can see here why. And then box 3 is the 80, the 10 doesn't get included, and of course we have to pay FICA and Medicare on the full wage amount, even if you've got a 401k plan. We all know that. So box 1 and box 5, 80 grand. Part of why I was saying we reconcile to box 5 is if your reasonable comp exceeds the FICA limit, then box 3 is going to stop at the FICA limit, and so that's not going to help us. We pay the guy $300,000 and reasonable comp is $300,000, and we still need to reconcile. Did we get the health insurance in there? Did we get the 401k out of there? And so that's why box 5 will be a much better marker. Box 1 and 5 are the ones that we'll really reconcile to. Now, box 12A, code D, the $23,000 IRA contribution, or 401k, contribution, and then box 14, like I said. And then this is what the W-2 really looks like, and I've made up the federal tax withholding and the state tax withholding. But that's where those numbers all come from, and it's where they all go to. And so again, now in this example, on the wage side, this taxpayer is going to end up paying tax on $57,000 of income. The $67,000 in box 1, and then that 14 in box 14, that $10,000 will be deducted, so that the net effect is they pay tax on $57,000. Plus, of course, whatever their S corporation had in earnings, that's going to flow through. But just on the wage side, this is how it happens. So the S corp does not get a deduction for that health insurance. Kind of gets grossed up into officer's comp and then deducted out based on box 14. And that it's got to be done right, or you don't get that deduction. So that's why I'm harping on that. So let's get on to, we figured out that the client has made an S election without us and taken distributions of $10,000 a month. It's December, so they've already taken their December distribution. So they've taken $120,000 worth of distribution. We run the RC reports and figure out that their reasonable comp is 80. We know the health insurance is 10. We've got cash available, so we can literally process a payroll for 80,000, get the 10,000 properly into box 1 and box 14, figure out the Social Security and Medicare tax, withhold that from the employee, match it with the company's side. So, it's actually going to cost us $86,120 in cash flow because we've already paid the health insurance. And if we haven't paid it and the employee has paid it, we got to run that through the S Corp's books, because they can't deduct this on their personal tax return if it didn't run through the S Corp. State unemployment tax, we're going to have some of that. We're all from 50 different states here, so I don't know what yours is in your case, and the rates depend on the taxpayer and all that kind of stuff, but it isn't going to be zero. Federal unemployment, $42, not the end of the world, but still needs to be accounted for. And then other local payroll taxes. I'm coming to you from beautiful downtown Denver, Colorado. We have an occupational privilege tax in Denver, so the employee man, I can't remember now off the top of my head, but $5 I think is what the employer pays, and 4.25 is what we have to withhold from the employee. $9.25 a month. Still, it's not a big number, but it's got to be done. And then Colorado has now a family medical leave deal where we pay 0.45% to almost 0.5% up to the FICA limit there too. So again, the shareholder is now an employee. We got to pay those amounts, so we got to account for that. Might be zero in your case, but it's not going to be zero in every case. Certainly isn't in Denver's case. So we've got plenty of cash available. What do? We process payroll for the year. Remember to add the health insurance, reconcile so we've got it all right, pay the company's payroll taxes. We're good to go. No big deal. We're just out an extra $80,000 that maybe the taxpayer didn't know they were going to need to do, but they do need to do it. So I'm reconciling for you again without the 401k in this case, because generally that would be the case, because we probably haven't set up a 401k plan yet, since we didn't even know that we had the S election yet. So in this case, the 401k is not there, and you can see the reasonable comp is the 80, 10 for the health insurance. Box 3 and 5 show the 80, not the 90. Got the $10,000 in box 14. So this taxpayer is going to pay a net of $80,000 in income. They're going to pay tax on $80,000 because we added 10 to their box 1, but we subtract it back out on their tax return. And here's what that W-2 looks like, just so you've got this somewhere if you ever want to come back and take a look to how it really happens. When you see these thought bubbles, as I told you, an awful lot of this course is bookkeeping. Processing payroll is kind of a bookkeeping function. But I still want us every once in a while to come back up to the 50,000 foot level and think as CPAs. And so really, in this case, what I want you to think about is we got to protect the clients from themselves. I mean, that's just a theme for me. They don't know the rules. They're not supposed to know the rules. We're supposed to know the rules. So again, this $80,000 that we're paying them at the end of the year, there's an excellent chance, since they're making S elections without us, that they haven't made any estimated tax payments either. Maybe they have, but my experience is if I'm not running roughshod over my clients, getting them to do it, they don't do it. So there's an excellent chance here that this guy has managed to get this far in the year and hasn't paid a dime to the IRS, and he needs to. And since we got to do a W-2, even though we're doing it at the end of the year, we can withhold whatever's left from after we, pay the 80 grand, subtract out the Medicare and Social Security, and we've got $50,000 give or take left, and subtract the 401k if in fact that's the case. And then the other 50 we can send to the IRS and or the state as withholding. We can do that even on the last day of the year, and it still counts as if it happened ratably throughout the year. So we actually protect the client here, and we do pay a good chunk of their taxes. Maybe not all, but maybe close to all. And then next year, we can set it up that way going forward, where we pay him $80,000 a year, but he actually gets a paycheck of $0 every month because we're paying his taxes for him. Because in this hypothetical example, if he's got $80,000 in cash available to pay his payroll, plus he took $120,000 in distributions, that 120 grand had to have generated some profit somewhere. So while distributions are not directly taxable, we got to do the 1120S and figure out what the income is, and then all that flows through. But chances are it's going to be north of 120 grand, or he wouldn't have had the cash to be able to give himself distributions in the first place. So this guy's probably going to have about $200,000 worth of income that he's going to pay tax on. The 120 that's going to flow through from income from the S corp, plus the $80,000 on the W-2 we're going to give him. So again, if we withhold $50,000, we're going to go a long way towards paying his taxes so that he's not going to have any underpayment penalties. And so just think about those kinds of things. We do this for an awful lot of clients where we process payroll first of the month, give or take, so that they can take a distribution anytime after that. And they don't see a dime from their payroll. Some of them still have to make estimated tax payments because their salary is not big enough to cover their taxes. So again, I've just put all these numbers together for you, like the fourth box down here. So there's still some room available by the time we take out the 401k contribution. We still have $50,880 left over. If they're over 50 and we're doing the $7,500 catch up, they've got $43,000 left over. But again, either of those numbers, whichever it is, can then be split, like I said, between federal and state taxes to get their taxes paid contemporaneously so they don't face any penalties going forward. We also have to remember, we're going to need $86,120 to do all this, pay the 80 grand and pay the employer share of FICA and Medicare. Plus, we've spent 10 grand during the year on health insurance, which we may actually have to spend reimbursing the taxpayer. And then on a monthly basis, that's all this is showing you do the same thing on a monthly basis, and we've got $4,240 we can send to the IRS or the state withholding if it's relevant in your state. So that means it's going to cost $8,010 a month in cash flow to pay this guy $80,000 a year. So let's be more realistic. We discover now, December 19th, made an S election, didn't do payroll, got to do reasonable comp, and we are strapped for cash like everybody always is. Now what? Well, December, if you're discovering this in December, which I'm assuming in this case, we can still probably manage to run that as a contemporaneous payroll, even if he took the distribution, on the 2nd of December, especially if he's the only employee and he's a new employee, that we're going to be a monthly depositor, which means that the taxes on that are going to be due by the 15th of the subsequent month. It's December, the subsequent month is January, 15th of January, still almost a month from now. We can say, we can pretend, for lack of a better term, if we're doing the payroll ourselves, let's run it now. And yeah, it happened on the 2nd of December, but we don't owe the payroll taxes till the middle of next month. We can get them paid. That's all good for this month. But the rest of the months, not so good. We're going to have to reclassify going backward. So starting with November in this case, because December we're going to do contemporaneously. So November all the way back to May, we're going to have to go back and reclassify those distributions as payroll, which means that we had payroll in Q2 and Q3, and now in Q4. We didn't make any of the payroll tax deposits that we should have because we're just discovering this now. There are going to be penalties and interest. We can certainly file the Q4 941 on time because it's not due till the end of January. But all the rest of them are late if we've never filed them, if we didn't have other employees. If we did have other employees, we're still going to have to amend them, add payroll to them, add FICA and Medicare tax expense, which means we're going to owe that, plus we're going to owe the penalties and interest on those amounts. In this case, we're not going to withhold any, because we don't have any cash anyway, any withholding for federal or state taxes, because all that would do is increase our penalties, because penalties are based on the taxes that you need to pay and withheld and need to submit to the IRS. So we're going to withhold 0 so that we don't have any extra, but Medicare and FICA we're stuck with. So in this case, we're going to have to amend Q2 because May is in Q2 and June for that matter. Then we're going to have to amend Q3 and Q4 will be okay. So penalties and interest here, they're not going to be horrible, but they're not going to be 0 and they're going to suck. They just might not suck to the degree that they can suck, which we'll get to. So reclassify backwards. If the IRS figures this out before you do, they will reclassify forward. So they'll start in January instead of in November. And they'll say January through August, you had payroll and you didn't file, you didn't pay. So you're going to have Q1 penalties and interest along with Q2, along with Q3, and they'll be higher than if you just do this yourself. So you save the client a little bit of money, not a ton, and it still stinks, but better than what the IRS will do to you when they figure this out. So we reclassify going backwards. We file the amended 941s and state and local tax returns, and then pay them and the penalties and interest. Again, we said no cash is available. We're gonna have to come up with some cash, and even if if we have 0 cash, let's get the returns filed and fixed, and then we'll have to pay penalties, when we can literally afford them. Because as I say here on the right side, even this no cash situation, we're still going to need $12,240 because we got to pay the company's share of FICA and Medicare and the employee share that we should have withheld from them. So we're out of cash. We paid them $10,000 in distributions. we're going to have to come up with cash somewhere to pay that $12,240. Plus, we're going to have to pay state unemployment. Federal unemployment will be due in January, and again, $42. That's probably not going to break the bank, but and then state and local payroll taxes, we need to keep those in mind too. Those numbers will no doubt be smaller, but there can still be some numbers there and some penalty and interest. So there is a more aggressive approach that we can take. There's no cash available, but we've got to do this right. We've got to dot our I's and cross our T's, or we should not do this. That's all there is to it. So instead of reclassifying those distributions as wages, let's reclassify them as loans. So in May, we took a distribution, let's say on the 2nd of May, and then we took another distribution on the 13th of June. Well, we need to document those distributions as loans with promissory notes. So we're going to have 7 of them, because December we're going to handle as a contemporaneous payroll again. But we got to catch up to get to the whole 80. So we got 70 to go. That's going to take us from May through November. So we reclassify the distributions, the $10,000 a month distributions, as loans instead of wages. And we document each of the 7 with its own promissory note. So a promissory note starting May 2nd, a promissory note starting June 13th, a promissory note for July, whatever the date was. And we use the relevant, the appropriate applicable federal rate for each of those months. It changes monthly. So each one will have a different interest rate. And interest rates may be going up or they may be going down, but they've got to be 7 separate notes. They're going to be signed today, 12/19. That's true. We're not going to go back and backdate them, but we are going to go and backdate that it happened. It started on May 2nd and it started on June 13th. So now the shareholder owes the company $70,000. We process a payroll for $80,000. We withhold as little as we can, just the FICA from them. And so we end up with, some $73,000 worth of quote unquote extra cash, which again will just be a bookkeeping entry for us to pay off the loans that we have documented in these promissory notes. And we might have money to pay the interest. If so, cool. If not, we're going to want the owner to pay the interest by the end of the year, preferably, because we need to be able to demonstrate to the IRS this was a legitimate loan transaction. Here's the document, the promissory note. Yes, it's dated in December because that's when we figured out we had a problem, but we charged interest from the date of the loan and we're going to pay the interest from the date of the loan. But now we can run a payroll and withhold that from the owner, a contemporaneous payroll. And have the owner write a personal check for whatever's left over, preferably this year, if not early next year, so that we can really show, yeah, this really was a loan and we really did expect to be paid, by the end of the year or by January or by February of the subsequent year. And we now have a contemporaneous payroll. So we don't have the penalties and interest. So we still owe that $12,000 plus by 3 or 4 days from now, if we're a semi-weekly depositor, if we have other employees and have $50,000 or more in the year of liability to the IRS. And if not, if we're smaller than that, and or if this guy is the only employee, then we'll be monthly depositors. And that $12,000 needs to be deposited by the 15th of January, the subsequent month. We can still do that because we're in December. Works okay. And in this case, got no 941s to amend. No state and local returns to amend, because again, like in Colorado and Denver, we do the ownership, the occupational tax, because he was an employee starting in December. So we're current. And same with the family medical leave. I mean, we got a giant check of 80 grand, so we're going to owe a fair amount of it, but it's contemporaneous. We're not late with anything. So this has worked fine, but it's got to be done right. You've got to have those notes. They've got to be documented. He's got to sign 7 separate pieces of paper. Got to have 7 separate interest rates for the federal applicable rate that was due in each month. Now, in this case, again, we're not going to withhold any tax because we don't have any cash. So assuming again that he hasn't made estimated tax payments, there's an excellent chance that he's going to owe a bunch of tax on April 15th, and we need to warn him of that. And he's probably going to have some underpayment penalty because he was supposed to make estimated tax payments and didn't. And realistically, he was supposed to do a W-2 and have some withholding there, and he didn't. So we're going to owe some money on April 15th. But that underpayment penalty is going to be minuscule compared to what the 941 penalties would be. But you got to do this right. If you're going to be aggressive, you got to be aggressive smart. So we've gone through so far, we discovered this in December. We had cash, that was easy. We didn't have cash, that was a little more complicated. We did some notes to avoid penalties and interest. If we're not willing to do that for whatever reason, then we're going to be paying some penalties and interest. We're going to be amending some 941s. What happens if we don't discover this until January? When we start talking to the client, hey, when are you going to get me your stuff? Oh yeah, I forgot to tell you, I made an S election. Oh, great. Chances are there's going to be penalties and interest in January, and I'll get to that here in a second. If we discover it later, you're going to find out very quickly here. There's even more penalties and interest. So again, if we do this before January 15th and we're a monthly depositor, we can still get the payroll taxes deposited by the 15th. We're not late. If we've got cash available, obviously we can do it pretty easily. If we don't, we still got to come up with that 12 grand. If not, we can reclass. Well, I shouldn't say it. If not, we still have to decide whether we're going to go back and amend 941s or file late 941s if he's the only employee back to Q2 and 3. Or we're still okay. We're not late with that 941. And we can consider the promissory note approach here too. But if they're a semi-weekly depositor, that means that their payroll taxes are due like 3 days after the payroll. This isn't going to work much after January 4th or 5th. So there's an excellent chance if we don't figure this out until January, we are going to have some penalties. But it's possible if we discover it early enough, we won't have, but probably we will. This probably won't work if you're using a processor like ADP or Paychex. They cut off 12/31 at midnight. They issue their W-2s by January 2nd, for crying out loud, if not even sooner than that. And I will also just jump in here real quick, back to the health insurance thing that I was harping on. If you're using a payroll processor like ADP or Paychex, they don't have any idea about that. And even when you tell them about it, they're still not going to have much idea. There are some people at ADP and Paychex that know about it, but they're 3 or 4 levels up. So seriously, if your clients are using these folks, I would start in October getting the health insurance amounts added properly to the W-2 so that we can get that deduction. And it's probably going to cost you extra money. It'll definitely cost you extra money if you're trying to do this with ADP and Paychex even in December or January, because they charge extra fees for everything. And if you're telling them today that you need to add the health insurance, which you do, and tomorrow morning you should be on the phone with these folks if you've got clients that are using these and are not accounting for their health insurance right. Get with ADP and Paychex and get that fixed now. It's going to be tricky to get it done between now and the end of the year, I will tell you. And so they're probably going to have to reissue the W-2 and all that, and that's going to cost you extra money. But still, it's going to save you $3,000 in tax. It's worth the extra $200 it costs you in fees. If you're figuring this out, and again, EFTPS takes 2 days to set up before you can make a payment. So really, if you discover it after January 13th, you're going to be in trouble. You're not going to get the payments done on time, and so there's going to be some penalties. But after January 15th, yeah, you're late. Your 941 can still be filed, but your deposits are late, and there's going to be penalties assessed. And it's 5% for each month, and not 30 days, but you're going to get, if you don't get it paid until March 1st, you're going to have 5% January, 5% February, 5% in March. So you want to get these paid as fast as you can. And obviously you're not going to have any more withholding. You're not going to add withholding because that just adds to your penalties and interest, and you might as well pay the underpayment penalty. Like I said, you're stuck with the Social Security and Medicare, both sides. That's true. Don't forget about state payroll stuff, because that's going to be a problem too. And remember, they got to get a W-2 now by January 31st as well. That's not hard. if you got other employees. But if this is the only employee, it's like, we've never done W-2s before. It's like, well, let's not forget, because we need to do them. So thinking like a CPA again here, getting back to the 50,000 foot level. Remember first time abatement. So if you do have some penalties, use first time abatement. 941 counts as its own return. But also remember, as I'm saying here, setting up payroll takes time. EFTPS takes time. Some states still have to snail mail you some codes. I mean, it can take 2 or 3 weeks to set up accounts. It's getting better and better, but it still amazes me how every once in a while we get into a different state and they still want things by mail. So that's going to be really hard to get this done in the amount of time you need to get it done. But at least you can get the 941, the federal stuff done. And if you got some state penalties, again, those dollars will be smaller. What if you discover this in February or later? And by later, sometimes we mean way later, from the standpoint that you take on a new client that's an S Corp, been an S Corp for 5 years. First, they're hearing of this reasonable comp concept. And yeah, no, I've never done payroll. I just take distributions. I mean, I'm the owner of the company. Yeah, they've got 5 years worth of problems, realistically only 3 of which the IRS is going to be able to go back to. But you got 3 years of this where 941s need to be amended, payments need to be made, penalties and interest are going to be there. There's just no ifs, ands, or buts. And even with first time abatement, great, you get Q1 from 3 years ago abated if you file it first, which you should do because those are going to be the biggest penalties. Well, I shouldn't say that depending upon what the payroll numbers are, but could be the biggest penalty. So think about that. But there's going to be penalties. There's just no ifs, ands, or buts. We're late on everything. So back to that slide I showed you at the very beginning, where are we in the year? I mean, should we make an S election right now, or should we wait until the first of next year? Always a relevant question. And the answer may be, yep, we're going to make it today for whatever reason. But often the answer is going to be, no, you know what? Let's get our act together, get our payroll account set up, even if we got to do some snail mail stuff. So they might not be set up until, the middle of January, because it's now the middle of December. It may take us a month to get this stuff set up the way we want. Fine. We can run payroll the 15th of December. They just aren't going to get paid until then, because we want a payroll system ready to go, because prevention, as I hope you're starting to see, is worth a pound of cure in this area. So back to the February or later, yeah, everything's late. Your deposits are late, your 941's late, your 940's late, your W-2s are late. So you're going to be paying some penalties. And again, if you take on a new client and they've got 3 years worth of stuff, you found out much later, and there's going to be a ton of penalties and interest. But again, like I said, the IRS figures this out before you do. They're going to reclassify going forward instead of going backward, and they're not going to allow the loan approach or anything like that. So you want to get ahead of this. You'll save your clients a little bit, even though they won't be happy about getting square with the IRS. But being unsquare with the IRS is worse. So penalties. It's just kind of funny, you got failure to file penalties, you got failure to pay penalties, you got failure to deposit penalties. Oh, wait, if I didn't deposit, well, of course I didn't pay. Isn't that the same thing? Well, it is the same thing, but there's 2 separate penalties. So you're going to get penalized here coming and going. And so we don't want to mess with payroll. We want to do payroll right every time, all the time, without exception, because the penalties are just nasty. The failure to pay and the failure to deposit, it's like 5% a month up to 25%. So the first 5 months cost you 5% a month. Plus, I think 0.5% a month on top of that, up to a max of like 12%. So, for 2 years, you're going to pay penalty. And then interest. And nowadays, with interest rates higher than they've been, that turns out to be a real number. And then on the W-2 side, you didn't file the W-2s because you didn't know that you had an employee. So there's a penalty for that, but there's also a penalty for failing to provide the W-2 to the employee. That failure to file a W-2, I think it's $50. I think it goes up eventually, but so it's not giant, but still we pay enough in taxes. Any penalty is just not cool. And like I said, the failure to file, failure to pay, failure to deposit, those penalties are nasty because the employee gets credit for whatever's been withheld from them, whether the company submitted it to the IRS or not. That's why the IRS is so persnickety about payroll stuff, because they got to give the employee credit for money that the IRS never got. So again, thinking like a CPA, like I said, remember first time abatement. Generally, you have to ask for it. Every once in a while on a 941, they will just say, hey, you screwed up on your last 941. We are waiving the penalties, but just don't do it again because there will be penalties going forward. So they've sucked up your first time abatement for you when they do that, whether you want them to or not. And then if you can't get first time abatement for whatever reason, because you've already used it, is generally the biggest reason, then you're going to have to establish reasonable cause. And if you go to the Internal Revenue Manual at 20.1.1.3.2.2, ignorance of the law and a mistake was made. I mean, those are factors that can develop into reasonable cause, but we really need more, frankly. But just, cite the IRM and say, hey, they didn't know that they were doing this, and now we've got it, and we're doing it right. It'll be fine, and please waive the penalties. Sometimes that works, frankly, and sometimes it doesn't. And this is usually what we're talking about here is the new client where we got to amend stuff, for 3 years. But if it doesn't work, appeal it and see if you can make a deal with the appeals people. So again, sometimes you can, sometimes you can't. But these numbers can be big enough that it's worth it. So the other thing is, we got to prevent this from happening. We got to stay current. We got to figure out payroll deposit issues with a client. Even if we're not doing their bookkeeping, it is just something you should just check in with them and maybe even get access to their EFTPS account so that you can log in periodically, take a look and make sure that everything is going on and the bookkeeper didn't get sick and forget to make some payroll tax deposits, because that's going to be a problem. It just is. So, let's pay attention to that so we can catch it sooner rather than later. And then, planning ahead for cash flow issues, both with salary and with health insurance, especially if we're shifting the health insurance to we're going to pay in the company instead of the shareholder that's been paying it himself all this time and isn't really eligible for the deduction as a result. Probably took it anyway, but again, the IRS catches that, it's going to go away and cost them taxes and penalties and interest on the personal side. So there's some myths that we need to avoid. For the 3-year person, I mean, can't we just issue a 1099 or even just put it on Schedule C? The taxes will be the same. The self-employment tax is the 15.3%, the 765 times 2. So, the IRS gets their money. It's not a big deal. Let's just do it this way. No, it's a giant deal. It's a violation of 4 or 5 federal statutes, which you don't, as a CPA, ever want to be involved in violating federal law, especially intentionally. I'm just looking the other way. This is quick and easy. Nobody will care. Yeah, the law requires they be treated as an employee. The law requires that employees be paid wages that show up on a W-2. So you can't just put it on a 1099. You're violating too many statutes. We put it on Schedule C. We're required to file an 1120S. And there's a per shareholder per month penalty for 12 months for not doing that. No. This is bad. I have seen seasoned CPAs give this advice, and I cringe every time. When you take Paul's course on reasonable compensation for S corporations, he will go over with you a real life scenario that actually RC reports knows happened for a fact, where a CPA had S corp clients, and one in particular, and he told the guys, hey, you need to do reasonable comp. And we're not doing it. Well, I told him, and he documented in his file that he told them. Then the IRS came along and said, hey, what's going on here? We're not doing reasonable comp. And the CPA said, I told them, I told them they had to do it, and they just refused. Oh, so you knew, and you prepared the return in violation of federal law anyway. So you know what? That'll be $6,000 in penalties. There's a $5,000 one and a $1,000 one. I don't remember off the top of my head which either one of them is called, but $6,000 in penalties. But just like with the Ginsu knives at midnight, but there's more. Then the IRS said, you know what? We're going to audit your book of business, Mr. CPA. So you've got 10 S corporation clients. Turns out the other 9 didn't do it either. And you told them all, we get it. You were aware of the law and even made them aware of the law. And then you went ahead and prepared a return that was in violation of federal law because they weren't getting the reasonable comp that they needed. So you know what? It's $6,000 times 10, $60,000 in penalty and interest. But wait, there's more. We're going to go back 3 years. So it's $180,000 in penalties. But that's not all. You order before midnight tonight, which the IRS did. Oh, you know what? We're also going to go to the Office of Professional Standards with you and charge you with basically being incompetent and revoke your authority to practice before the IRS. And if we do that and we end up revoking your privilege to practice before the IRS, whether temporarily or permanently, then we're also going to report that to the State Board of Accountancy in the state that you're licensed. And trust us, we're not doing this just to you. We do that to everybody that goes to professional standards and is adjudicated that they no longer have the authority to practice before the IRS, even for a little while, much less forever. And then the State Board of Accountancy steps in and revokes your CPA license. So did the IRS revoke this CPA's privilege to practice before the IRS? They did not. They required him to pay the $60,000 in penalties to appeal all this. He got a lawyer and managed to keep the Office of Professional Standards at bay, which meant that we didn't get this reported to the State Board of Accountancy. So he did hang on to his CPA certificate in this case, but it cost him $60,000 in penalties and legal fees, whatever those were. We don't know. So you will run into clients. You may already have clients. I'm not doing this. It's crap. Yeah, fire them. End of discussion. Not worth your CPA certificate and your ability to make money. Now let's talk about distributions going forward. So the rule is you have to do reasonable comp before you can do distributions. And we actually don't apply the letter of that law. We apply the spirit of it so that it's for the year. You got to do the $80,000 in this example of reasonable comp. You got to make sure that's paid. And then the distributions are fine, whether they happened, frankly, in January or they happened in December. As long as $80,000 in salary got paid during the year, you're good to go. So a couple of different ways you can do this. And again, what you got to make sure is that the client does not run out of cash by taking distributions and can't afford the $80,000 of reasonable comp. That must be done, period. End of discussion. It is required for every S corporation, regardless of, no, this is the first year they've been an S corp, so that doesn't apply, right? Wrong. Well, they're small, it doesn't apply, right? Wrong. Well, they only have real estate. Well, what the hell is real estate doing in an S corporation to begin with? But wrong. They are an S corp providing services. They must be an employee and must be paid reasonable comp. If they are a silent partner, doesn't provide an ounce of service, fine, you're right, they can get just distributions, but everybody else has to have reasonable compensation first. So let's pay them the $80,000 a month through August. I'm sorry, the $10,000 a month through August to get it paid. And then for the other 4 months of the year, we can pay them distributions. Let's pay them monthly salary up to $80,000. And then in December, we can make the $40,000 distribution, assuming they've got $120,000 they want to spend on payroll and distributions. That's where those numbers are coming from. No problem. This works perfectly. And again, keeps them from, if they run out of cash in September, they're fine because they haven't taken a dime of distributions. They just can't take a dime in distributions until they get that $80,000. We know that $80,000 is going to get paid during the year. And then realistically, what we do, we pay everybody the first of the month. And then if they want to take a distribution in the rest of the month, they can. But we got one client that did run out of cash at one point. So we're like, okay, you can't do that anymore. We're not taking the risk with you. But with others, we know they're going to be good for the 80 grand. Fine. You can take distributions monthly or quarterly or annually or whatever, when the cash flow allows for it and or your cash flow needs are there. So you can do this on a monthly basis. You don't have to wait. But if they're going to run out of cash, or they might run out of cash, wait. Because again, you can't be preparing a return that didn't pay reasonable compensation. Not worth risking your CPA certificate. Now some parting shots here, because I know I'm talking a million miles an hour, but I've only got 5 minutes left. My approach with my clients is to do my very best to keep them out of trouble. They don't know what they don't know. They're not supposed to know what they don't know. You and I know the IRS code, and we learn things all the time. How in the heck is the client supposed to figure it out? They're not, and they won't, and they can't. And so I'm supposed to protect them from themselves. And with the right knowledge from this CPE and the one for Paul Hammond's course, you'll be much more of an expert in reasonable comp than you are now once you've got those two courses under your belt. But just means we got to have conversations with our clients so we know what's going on, so that we can help them always maximize their after-tax income. Hopefully they're not making S Corp elections without us. Hopefully we would never have a client that would do that. I fully understand we might take some clients that they're now a client, they've been screwing this up for years, and we got to unscrew it. That's a different set of facts, even though everything I've said here obviously applies, as I've said. But, and I don't take very many new clients, but my favorite line to potential new clients is, you're going to have to tell me stuff you don't even tell your doctor. So if you're not comfortable with that, because you're not comfortable with me, cool, find somebody you are, because I need to know way more about you than any of your friends do, that your family does. I know things that I don't share with anybody, but when I know them with you, I can help you make the best of them. Like I said, there will be times when, clients, family members make decisions that mean we need to end our business relationship. We don't have to end the friendship. We don't have to end the family relationship, but I can't be signing your return and risking my CPA certificate. So I know you came to this class to learn how to fix a bad situation, but my hope is I have really drilled into you that we want to make sure our clients don't get into this situation in the first place, and that we only have to deal with this with new clients. So I've got a lawyer client that has been a client for, like 8 or 9 of the 11 years that I have been in business. And he has a special file. It's called John Morse's reasonable comp crap. And he loves me and trusts me and respects me in the same. And he's got a master's in tax himself. He practices state law, trust and estate kind of stuff, but he has no diddly about S corporations. And so, I'm like, yeah, we got to do this reasonable comp thing. And every year we got to figure out again, what's your reasonable comp for this year? And he hates it. So he has a file, John Morse's reasonable comp crap. And he talks to his lawyer friends, and none of their CPAs make him do this one, so that's why it's John Morse's reasonable comp crap. Because John Morse has made it clear to me that, I got to do this. And if not, I'm not a client. And I want to be a client. So, okay. And finally, he did have another lawyer like, oh yeah, my CPA makes me do it too. So then, it finally dawned on my client, John Morse is just keeping me out of trouble more so than the average CPA does. So look at RC reports. We'll make this lickety split easy. First time you do it, might take you an hour. The rest of the times it'll take you 10 or 15 minutes. Betsy, who I said works for me, she does this for me now. She's way better at this point than I am. And the documentation that you get a deliverable, stands up to the IRS every time one of these things, RC reports has been in an IRS examination. The IRS has accepted the RC report and just moved on. So just do that. And I know that I am out of time here, so I'm not even getting to your questions. But you can reach out to me here at john@rcreports.com if you've got any questions. And again, I very much appreciate your attention and the privilege of an hour of your time. I wish you the very, very, very best in your practice. And in this holiday season. And if you're watching this after the holiday season, have a great March, February, spring, summer, whatever it is. It's just not the holidays that need to be joyous. It's all year long. So thank you for listening and have a great day.
Thanks so much, John. And for everyone who's attending this live, here's a quick reminder on how you can earn CPE.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.